Chapter 23 is spreads combining calls and puts. We're first going to start off by covering the butterfly spread. This is a neutral position that has limited risk as well as limited profits. It utilizes three striking prices, bull spread between the lower two strike prices and a bear spread between the higher two strikes. The maximum profit is realized at the middle strike at expiration, and the max loss is realized that the strike price is above the higher strike or below the lower strike at expiration. There are four ways in which the butterfly spread can be established. So in this example, you can see the four different spreads that can be established. This table above summarizes the four ways the butterfly spread might be constructed. In each of the four spreads, the max profit at expiration is 8 points if the underlying stock is at exactly 60 at that time. The max loss in any of the four spreads is 2 points if the stock is at or above 70 at expiration or below 50 at expiration. A butterfly spread is not an overly attractive strategy, although it may be used from time to time. This strategy would be most effective if one has a low commission cost, as well as if the potential profit is at least 3 times the maximum risk, and the underlying stock appears to be in trading range. Moving forward, we're going to be speaking on the condor and the iron condor spreads. Condor spreads are very similar to butterfly spreads, except one uses two different strike prices in the center of the spread. These spreads are constructed with all call options or all put options. Iron condors are essentially the same thing, except they contain a mix of puts and calls. In actual practice, a knowledgeable trader would use the iron condor strategy if the desire is to establish a strategy of this type for all of the options are initially out of the money and the position is established for a credit. So here's another example showing the iron condor spreads. The difference in the call strikes and the put strikes should be the same, which is 5 in this example. All of the options are out of the money to begin with. The position is always established for credit, since the options being sold have strikes closer to the current underlying stock price than those being bought. If the underlying stock closes between the two middle strikes at expiration, all the options will expire worthless, and the trader will profit by the amount of the initial credit, less any commissions. So in this example, the maximum profit is $100. Moving forward, conversely, if the underlying is outside of either the long strikes at expiration, the maximum loss is realized, which would be 400 in this example, as you can see from figure 23.1 and the little description to the right. The margin required for this spread is the max risk. One can lose 100% of their investment in this position if the underlying is above the strike price or below the strike at expiration. This strategy has a lot of risk, and ultimately these are very popular spreads. There's a large chance of making a small profit, but there's also a small chance of ruin.
Combining an option purchase and a spread, bullish scenario. Combining an option purchase and a spread is generally used when investors feel that an underlying option is overpriced and therefore they do not want to purchase a call or put by itself. Assume that XYZ is selling at 100 and one wishes to purchase the December 100 call as an outright bullish speculation. The call is selling for 10. However, one determines that the December 100 call is overpriced based off an option pricing model similar to the one we've used in class. Hence, the investor decides to use the following put spread in addition to buying the December 100 call. Selling a put credit spread includes selling a December 90 put at 6 and buying a December 80 put at 3. Thus, the total expenditure for the entire position is 7 points, 10 for the original December 100 call, less 3 credit from the sale of the put spread. If the investor is correct about his bullish outlook, both the puts would expire worthless, receiving a net of 3 credits, and the expense for the December 100 call, which was overpriced at 10, is effectively 7. If one is incorrect about the bullish outlook, risk increases because the call expires worthless and you lose your 10, and the spread is ineffective, therefore losing 7 credits. Because the width of the spread is 10, the 90 put minus the 80 put, less the 3.0 credit earned. Combining an option purchase and a spread, a bearish scenario. Again, this is generally used when investors feel that an underlying option is overpriced and therefore they do not want to purchase the call or put outright. In this bearish scenario, XYZ is selling at 80 and the investor is wishing to purchase a put that is valued at 8, which is expensive. The investor can sell a call credit spread by selling a December 90 call at 4 and buying a December 100 call at 2. If one is correct about his bearish outlook, both the calls would expire worthless, therefore receiving a net credit of 2, effectively making the expense for the December 80 put, which was overpriced at 8, 6.0. If one is incorrect about the bearish outlook, the put expires worthless at 8.0, and the spread is ineffective. You would lose 8 credits, or lose 8 debits, because the width of spread is 10. 100 minus 9 on the December calls, less the 2.0 credit earned. Follow-up actions for bull or bear spreads. Reasonable value verification. Suppose one already has a bull or bear spread in place and the underlying stock has advanced nicely and is above both strike prices used in the spread. However, the bull spread may not have widened out to its maximum profit potential of 10 points, as noted in the previous examples. One can employ puts for 2 purposes in this case. 1, to determine whether the call spread is trading at a reasonable value, and 2, to try to lock in profits. First, we'll discuss reasonable value verification. Take for example that XYZ increases from 80 to 88. The investor buys an XYZ call bull spread for 5 points, which includes a January 70 call and a January 80 call. The max profit potential call spread is 10 points, 80 minus 70. The current call spread is 7 points, and the investor is disappointed that it hasn't widened out to its maximum profit of 10 points noted earlier. The investor could observe an XYZ put spread to get a reasonable value verification for his call spread. If the put spread is 3 points when your call spread is 7 points, which equals the total width of the strikes, 80 minus 70, one can infer that the spreads are in line and trading at theoretically correct prices. Even though that they're not at max profit potential according to the investor, they are at max profit potential currently according to market prices. Follow-up actions for bull or bear spreads, locking in profits. It's best to observe an example here where XYZ increases from 80 to 88 and the investor buys a call bull spread for 5 points. The max profit potential on the call spread is 10 points, as noted earlier. Both calls are in the money at 88, and therefore the market projects the January 70 call to have a current bid price of $17.50 and an ask price of $18.50, and assumes the January 70 put to have a bid price of 20 cents and an ask price of 40. This also assumes that the January 80 call is at a 7.8 bid and 8.2 ask. The put for January 80 is at a 0 bid and a 10-cent ask. If the investor was to remove the spread at market prices, he would sell his long January 17 call for $17.50 and purchase his short January 80 call back for $8.20, a net credit of $9.30, which is 70 cents less than your maximum profit potential of $10. If the investor was to utilize puts in this scenario, he could lock in his 10 credit call spread profits by buying the January 80 put for 40 cents and holding both the put and the call spread until expiration. At expiration, the call would unwind for a 10 credit, less the 40 cents paid for the put. Therefore, the extra credit would be $9.60. This is still less than the maximum profit potential of $10, but 30 cents more than the $9.30 spread on the credit spread alone, on the call spread alone. Similar techniques like this would be employed if you owned a bear spread. Now we'll get into some more complex spreads. The first is a two-pronged attack aka a dual calendar spread. This involves combining a bullish calendar spread with a bearish calendar spread. When a stock is midway between two strike prices, one might establish a bullish out of the money call calendar spread and simultaneously establish a bearish out of the money put calendar spread. If the stock remains relatively stable, both near-term year 1 options would expire worthless, and both long-term year 2 options could produce large profits with a substantial stock price movement in either direction. When I say year 1 and year 2, one would assume that the near-term stocks or near-term options are expiring in the current year, and the longer-term stock is expiring in the following calendar year. With this strategy, the spreader does not care about the direction of the stock volatility as long as the option is volatile itself. The investor is hoping that the stock moves in a large distance in either direction. After the near-term options expire worthless, it would be wise for the spreader to generally hold the combination in hopes of achieving the highest mentioned profit noted in the bullet point above, even if it means letting small profits decay into losses. That is because this strategy generally sustains a small number of losses, but provides opportunity for large profits that can outdistance any losses earned. Next, we'll discuss the calendar straddle, another complex scenario. Selling a near-term straddle and simultaneously purchasing a long-term straddle is what makes up a calendar straddle. Since the time value premium of the near-term straddle will decrease more rapidly than that of the long-term straddle, one can make profits on a limited investment. Limited risk up until the near-term straddle expires, and if the underlying moves up or declines in price by a substantial amount, the worst that can happen is the difference between the straddle prices shrinks to zero. Therefore, the loss is limited to an amount equal to your original debit plus any commissions. If the near-term options expire and the strategist decides to buy back the near-term straddle and continues to hold the longer-term one, his risk increases by the cost of buying back the near-term straddle. However, maximum profit could be realized if XYZ were exactly at the strike price at the near-term expiration. The near-term straddle could be brought back at a fraction of the cost, and the long-term straddle could still achieve its maximum profit value. Losses are limited, and there is a large potential for profits with only a small increase in risk. If large profit isn't realized, losses are minimized, just like in the prior example. Next is owning a free combination, aka the diagonal butterfly spread, and it is another complex scenario. This includes selling a near-term straddle and simultaneously purchasing both a longer-term out-of-the-money call and a longer-term out-of-the-money put. Potential results from this position can vary widely. However, the risk is limited before near-term expiration, similar to the calendar straddle. The objective is to be able to buy back your near-term straddle for a price less than the original credit received. If the investor can do this, he will own the longer-term combination for free and can profit greatly if the underlying moves in either direction. When operated over a period of market cycles, this strategy can produce large profits. Ideally, these profits would offset any small losses that had to have been taken, similar to the calendar straddle. Criteria for selecting which spread to use. For the calendar combination, you're going to want a relatively volatile stock. You're going to want that stock's price to be nearly midway between two strike prices. You're going to want the strike prices to be at least 10 points apart. You're going to want 2 or 3 months remaining until the near-term expiration, and the price of the near-term combination greater than 1/2 of the price of the longer-term combination. For the calendar straddle, you want your stock near striking price initially. You would like 2 to 4 months until near-term expiration, and the near-term straddle price to be at least 2/3 of the longer-term straddle price. For the diagonal butterfly, one would want the stock near the middle striking price initially. You would look for 3 to 4 months to near-term expiration. You would like the price of the written straddle at least 1 1/2 times at the cost of any longer-term out-of-the-money combinations, and the risk before near-term expiration should be less than that of the net credit received. In summary, puts and calls can be combined to make some very attractive positions. The addition of a call or put spread to the outright purchase of a call or put can enhance the overall profitability of the position, especially if the options are expensive. All three complex strategies noted offer the possibility of large profits if the underlying stock remains stable until the near-term options expire. All three complex strategies have limited risk, even if the underlying moves explosively in either direction prior to near-term expiration. It should be noted that Many of these strategies are complex for basic consumer investors and would be expensive in commission costs. That being said, the text recommends that someone who is first getting into options trading does paper trading so they can learn the ins and outs before they move into real world practice.